The currency world is holding its breath today as fresh developments emerge concerning the Iraqi dinar. From unexpected supply shifts to whispers of covert regulatory deliberations, the situation is charged with tension and possibility. Behind closed doors in financial corridors from Baghdad to Washington, informed voices are reporting under-the-radar developments that could soon reshape the landscape of this much-debated currency. This is not idle speculation. From multiple independent sources comes a convergence of insight pointing toward a turning point, details that demand attention. Sources close to policy discussions reveal that in recent days, Iraqi monetary authorities have accelerated procurement of foreign reserves. These moves have been described as unusually aggressive for this time of year. The pace and volume, substantially higher than typical seasonal patterns, suggest a deliberate strategy to stabilize or even support a potential revaluation. Although precise figures remain confidential, insiders indicate that this heightened activity spans multiple central bank channels, importantly, not publicly disclosed through standard reporting mechanisms. Analysts monitoring central bank activity have noted subtle but consistent signs pointing toward a directive issued earlier this quarter. Concurrently, a sophisticated network of regional banks has reportedly received subtle signals regarding revised intraday trading spreads, suggesting potential softening in official buy-sell margins. If enacted, such a change would render buying more attractive and selling more profitable, an operational recalibration that could signal impending policy easing. From key trading desks in Gulf financial centers, whispers have formed of intricate recovery plays coordinated between Baghdad and regional partners. One senior trader, speaking off the record, conveyed that we are seeing alignment that only appears when a strategic shift is imminent. Equally noteworthy are the murmurs of diplomatic overtures between Iraq and certain G20 Treasury counterparts. These are described as confidential dialogues focusing on liquidity support and macroprudential reassurance. Historically, such conversations intensify in advance of planned monetary policy adjustments, especially where foreign exchange regimes are under evaluation. Observers believe that the scope and tone of these exchanges indicate more than routine coordination. They suggest groundwork being laid for realignment. Simultaneously, FX analysts are tracking an unusual uptick in long-term forward positions across regional currency derivative markets. Positioning is growing noticeably, particularly among institutional investors in Dubai and Abu Dhabi. The volume of these forward contracts hasn't reached extremes, yet the directional skew, favoring appreciation, has caught experienced eyes. One analyst commented, "The clients stepping in now are not speculative tourists. They're professionals who know what to look for. They see a narrowing window to act." This under-the-radar accumulation hints at market anticipation that the Iraqi currency may soon find its footing stronger than current rates imply. Yet with all this, caution remains paramount. No formal announcement has been made. Public statements from the Central Bank of Iraq remain consistent with a posture of stability. Monetary authorities continue to stress that the dinar is pegged and that current exchange levels reflect careful policy calibration. Officially, there is no deviation from the status quo. But as any market insider knows, official messaging is often designed to preserve order and signal predictability, especially when deliberate shift plans are implicitly upcoming. While these structural developments unfold, individual sentiment reflects impatience and restrained hope. Rumor mills have circulated narratives of a revaluation at figures double or triple the current rate. Yet experienced voices push back against such hype, reminding us that any recalibration would likely align with broader macro targets and fiscal sustainability, not dramatic overnight jumps. More plausible, insiders posit, is a measured adjustment calibrated to support debt servicing and import resilience while maintaining capital flow confidence. Beyond the technical mechanics, geopolitical undercurrents add another layer. Iraq's improving oil revenues, tied to global price upticks, boost fiscal flexibility and reserve confidence. Talks of IMF technical support remain confidential but ongoing, with international agencies reportedly reviewing recent data flows. Advances in Iraq's budget projections and an uptick in foreign direct investment inquiries are also feeding into the reserve picture, generally positive signals that feed currency credibility. Trading desks say the mood is electric, a tense optimism tempered by years of caution. Risk managers are recalibrating exposure thresholds, noting that volatility could spike if even modest policy shifts are communicated. Firms are reportedly refreshing their internal modeling to accommodate an adjusted peg scenario or a managed float variant. Simulations that were dormant since previous speculation cycles have been dusted off. Spreads, execution algorithms, risk limits are all being stress-tested against potential moves in either direction. Amid this, retail whispers continue to swirl among expatriate communities and diaspora investors. Social media platforms, encrypted messaging groups, and informal community forums are alive with questions and theories. While this environment breeds noise, it also serves as an informal barometer of sentiment. And sentiment, after all, can become self-reinforcing. Caution remains essential. Speculative fervor can distort perspectives if not grounded in fundamentals. From an operational standpoint, any change process would likely roll out carefully. Some predict a graduated pilot in trade settlement mechanisms before broader exchange tools shift. This would mirror past central bank approach patterns, where policy shifts were first tested among approved counterparties before public implementation. Frontline bankers note that confidential assurances to key market makers could precede any public statements by days or weeks. This stage, they say, is already unfolding subtly behind the scenes. As these layers overlap, reserve buildup, forward positioning, diplomatic alignment, operational recalibration, the picture grows more compelling. While the timetable remains opaque, the coordinated nature of these shifts suggests more than coincidence. The confluence of signals, slowly accumulating yet unmistakable, speaks to an elevated probability that something meaningful could happen in the not-too-distant future. It is critical to underscore that no official commitment or detailed plan has been announced, and any roadmap remains subject to change under evolving geopolitical and economic conditions. Unanticipated global shocks, shifts in oil dynamics, or regional tensions could delay or derail even the most carefully mapped strategies. Risk remains high, and history reminds us that delayed announcements or abrupt reversals are entirely possible. We recognize the emotional weight of this narrative. Many have waited years, even decades, for a breakthrough. Hope has been tempered by cycles of speculation, frustration, and economic turbulence. Now, those over a decade-long waits face a final moment of truth, or yet another delay. That psychological tension can be overwhelming. But in these final hours of the clock, clarity and composure matter most. Don't allow fear or greed to cloud rational decision-making.